Hi, my learners. This is Mr. Mboli. Today we are going to do a topic in accounting, and the name of the topic is companies ledger account. Alright, we are going to prepare the following account. Number one, the ordinary share, return income, dividends on ordinary share, source income, and the appropriation account. Let's read the information. You are provided with the information relating to Mofokeng Traders for the year ended 30 June 2013. The authorized share capital consists of 800,000 ordinary share. We all know the meaning of authorized shares. When we talk about authorized shares, is the maximum number of shares the company is allowed to sell or to issue. All right. Now let's start by preparing the ordinary share capital. Remember, always you start by recording your balances. Ordinary share capital, we have a balance on 1 July 2012. Then it's gonna be 2012 here, July 01. You write balance here, and it's balance brought down. How much is the balance? 2,500,000. 500,000. Then you come to return income. You go to return income, and it's gonna be 2020 12 July 01 balance brought down. How much is the balance for return income? Is 950,000. And then when we talk about the return income, we must always close it off to the appropriation account. We close it off to the appropriation account as how much? General as how much? As 950,000. Then you go, because you have you have wrote it here. Then now you must go to the appropriation account. On this side is debited. Then if it's debited on the return income, it must be credited on the appropriation account. Then you're going to write here the returned income. This one is gonna be 2012 July 01 general. It's gonna be how much? It's gonna be 950. Okay. The other balance that we need to record is the SARS income tax. Remember, this one is a liability. And what do we know about a liability is that a liability decreases on the debit side and increases on what? On credit side. Then because here we are having a credit balance, it means that we are owing SARS. Then we must record it on the credit side. Then it's gonna be 2012 July 01 balance brought down how much? 17,000. Do we have any other balances? Yes, we do have. Shareholders for dividends. Remember, this one is what we call a final dividends. It's always a liability. Remember, this one it's declared and not paid. Let's go and record it now. Dividends on ordinary share capital. Dividends on ordinary share capital. Shareholders for dividends. Okay. We were supposed to have an account for shareholders for dividends. We said this one is a liability, and what do we know about a liability? What do we know about a liability is that a liability increases on the credit side and decreases on the debit side. Because we are owing our shareholders, then we are going to have July 01. We are going to have balance brought down. How much are we owing? I think it's 125,000. 125,000. All right. Now we are done with recording all our balances now. Then we can now continue with the information now that we are given. All right. What we have there, we have the following balances. We are done with that one. Let's read now. On 1 July, the company issued a further 200,000 shares at 6 rand, 40 each. All the monies were received and banked. All right. Then obvious, when we are issuing shares, the ordinary share capital is affected. And every time when we are issuing shares, it must go on the credit side. Let's go now and record it now. We are issuing shares. Obvious, the money will go to the bank. When was these shares issued? The shares were issued on 1 July 2012. July 2012. Oh, I'm sorry. It's gonna be July 01. Obvious, it's gonna be general, not general, CRJ. We are going to receive money. Then how much now? We can just put your calculation in bracket. It's gonna be 200,000 multiplied by 6 rand 40. Let's do it on our calculator now. Let's do it on our calculator. 200,000 multiplied by 6 rand 40. It's gonna be 1,280,000. Okay. So now we can continue with our information now. On 30 July, SARS and shareholders for dividends were paid the amount due to them. Remember, these balances now that we were given, this balance that we were given under SARS, it means that we were owing SARS. Then now we are paying it. Obvious, when we are paying it, money will go out in the bank account. Then it's gonna be CPJ. How much we were paying? We are paying the 17,000 that we were owing. When did we pay the 17,000? We paid it on 30 July. 30 July. Oh, I'm sorry. I was supposed to record it here. 2012 July. When did we pay it? 30 July. Then we are no longer owing SARS now. Let's continue now. We also paid now the shareholders for what? For dividends. Obvious. The bank will be now affected CPJ because we are paying. How much we are owing? We were owing 125,000. And then when did we pay it? 2012 July 30. Okay. Then now we can continue with our information now. Now this is information number 1, number 2, number 3, number 4, number 5, number 6, number 7. We don't have number 8. Let's go to information number 3 now. On 31 December 2012, the company paid a provisional tax of 270,000 and an interim dividends of 20 cents per share. This was applicable to all shareholders. Now, we are paying our first provisional payment for SARS. Let's go now and record it under SARS income tax. Let's go and record it under SARS income tax because we are paying now. Our first provisional payment is gonna be CPJ now. It's gonna be CPJ. How much we are paying? According to our information, we are paying 270. We are paying 270 according to our information. Remember, they said now an interim dividends of 20 cents per share was paid on this date, and this was applicable to all shareholders. All right. Now, let's go and check now. At the beginning of the year, how many shares we're having? We had 500,000 shares at the beginning of the year. Where then during the year, we issued a further 200,000 shares. Then it means that at the end, when we were paying the interim dividends, we had 700,000 shares in total. Then it means that we are going to calculate our interim dividends using the 700,000 shares. Let's go now and record it. Where are we going to record it now? Here we are going to record it under ordinary share capital. When did we pay the interim dividends? We paid it on the 2012 July 30. But we paid it interim dividends. Remember, interim dividends is declared and paid. Then bank is affected. Then CPJ because we are paying. Then here you can just open a small bracket, or even inside you can just open a small bracket and write your calculation. Multiply by 20 all over 100 now. It's gonna be 700 multiplied by 0.20. It's gonna be 140. That means on this date we paid 140. All right, let's continue now to our next information. Information number 4. 30 June 2013, At the end of the accounting period, the company made a second provisional payment of 250. Then we're gonna go and record it to our SARS income tax bank because we are paying CPJ. How much did we pay? 250. When did we pay it now? You can just write a date there. When did we pay it? And then we paid it on 30. We paid it on 30 June 2013. And then remember this one, it was December 2012 31. This one is gonna be 2013 June 13. Okay. Now let's continue with our information now. Information number 5. The directors decided to buy 60,000 shares from shareholders at 7 Rand per share. A check was issued. Remember, we are no longer using checks, so we paid it via EFT. Alright, now we are buying back the shares. Obvious, if we are buying something back, money will go out of the bank account. We are talking about shares. Obvious, ordinary share capital is affected in this case. Let's go to our ordinary share. Remember that ordinary share increase on the credit side and decrease on what? On the debit side, because we are buying back. It means now money will go out of the bank account. Then CPJ. And then you can here just write your calculation in what? In bracket now. Now you need to listen to me very carefully now. But when it's come to the buying back of shares, here now we want the average price. Let's go now and calculate the average price now. I'm gonna prepare the note for ordinary share capital. At the beginning we have these shares issued at the beginning, and we were given the amount as 2,500,000, and then during the year we had 200,000 shares issued. Do we have the amount? Yes, we do have the amount. We calculated the amount as how much? There's 1,280,000. 280,000. All right, now we are having the buying back of what now? The buying back of shares. How many shares were repurchased? 60,000 shares repurchased at now an average price. Here we always looking for average price. Remember, how do you calculate now average price? Average price is equal to the total amount of shares issued divided by the total number of shares issued. In this case, when we talk about the amount, we talk about this amount. Then it's gonna be 2,500,000 plus 1,280,000. You just add the 2, then the total is gonna be 3,780,000. Then now all over the total number of shares, when you add this 500 plus the 200, is gonna be 700,000 shares. This is how we calculate the average what? Price. Now let's check the average price now. Divide by 700,000. then our average price it's gonna be 5 rand 40. On our calculation, on my calculator, I don't put the zeros because the answer will be the same whether they are there or they are not there. The answer will be the same. All right, I hope you understand why I'm not putting the zeros. If they are 3, then I don't put them. All right, this is our average price. Every time now, when you calculate the buying back on the ordinary share capital, you need to use the average price. Remember how many shares were repurchased? 60,000 shares were repurchased. Then it's going to be 60,000 multiplied by 5 rand 40 now. 5 rand 40 now. 5 rand 40. 5 rand 40. It's going to 5,4 multiplied by 60,000. It's going to be 324,000 now. I think we are done with our ordinary share. Once you master this one, then the rest is gonna be easy for you. Okay, let's go to our next information now, but I'm not done with this one. Let me just finish this adjustment number 6, because these shares we bought them at 7 rand, but remember the average price is how much? Is 5 rand 40. It means that we bought the shares above the average price. Obviously, we have lost a certain amount there. Then where did that amount comes from? The difference. Where does the difference comes from now? The difference will come from the return what now? The returned income. The difference will comes from the returned income. Because when we are doing returns income, we normally do it using the appropriation account, but the difference will come from the returned income. The difference will come from the returned income. Here we are having income tax. We are also having dividends on ordinary share. Dividends on ordinary share. Then our last one is the returned what? The returned income now. Okay. The returned income now. Okay. Now let's continue with our information, and I'm gonna show you how we record the buying back on the appropriation account. Okay, let's continue with our information now. On the June 2013, the directors declared a final dividend of 60 cents per share. This was applicable to all shareholders, including new shares issued and repurchased shares. So now the company is now declaring, remember, final dividends is declared and not paid. Because it's declared and not paid, it becomes a liability for the company. But they are saying this information is very important now. This was applicable to all shares. If they are saying this was applicable to all shares, including the new issued and repurchased shares, it means you are going to cancel the repurchased now. You're going to take 1, 2, you combine the 2, and then it's going to be 700,000 multiplied by 60 over 100. Then we are going to record it under dividends, under ordinary share dividends now. Then because this one is not paid, it only declared, then it becomes a liability for the company. Here now we are going to write shareholders for dividends. Remember, this one is declared and not paid. Then you can open a little bracket there and write your calculation. Multiply by 60 over 100. It's gonna be 700 multiplied by 0.6. It's gonna be 400 and what? And 20,000. General. You can just write the date here. And then at the end of the year, when is our financial year ending? Then our financial year end on 30 June 2013. Then June 2013 30, we're gonna close this one to the appropriation account, general. Then we just add the 2. It's gonna be 140 plus 420. Then we are going to close off 560,000. We close off 560,000. Then this one is 560,000. Then because we wrote appropriation account here, this amount must be shown in the appropriation account. Dividends on ordinary share capital is 560. Then we are done. 560, we are done. Let's continue with our next information now. 30 June 2013, we are done with this one. 30 June 2013, the net income before tax for the year was calculated as what? As 1,700,000. Okay, where do we see the net income before tax? We see the net income before tax under the appropriation account. This one is gonna be net profit before tax now. And then it's gonna be how much we are given? 1,700,000. Okay, let's continue with our information now. Here now, the net profit before tax is 1,700,000, and then income tax is calculated at 30% of the net profit before tax. Then now we are going to calculate the income tax. How do we calculate the income tax? They are saying it 30% of the net profit before tax. 30 all over 100. General. Yeah, general. Then let's do it on our calculator now. It's gonna be 1,700,000 multiplied by 0.30. It's gonna be 500 and what? And 10,000. You can just write your date here. 2012 July. I think it's 2013 July 01. You just write the date there. Okay guys, then now we are done with our appropriation account. But remember there is a buying back. Now I'm gonna manipulate now the appropriation account and put the buying back now. I'm gonna manipulate it and put the buying back now. Okay, but before manipulating it, let's close off all the other account. SARS income tax, we are having income tax here. And then the income tax was 500 and what? And 10. When we are paying our first, we are paying our second provisional payment, we are trying to reduce this amount. General. Let's check now either we are owing SARS or SARS is owing us. How do we check that now? Check the bigger side. Which one is the bigger side? 17 plus 270 plus 250. Okay, obvious. The debit side is the bigger side. It's gonna be 53,000. It's gonna be 7,000. All right, then now you just balance it off. Now how do you balance it off? Minus 510 minus 17,000. It's gonna be balance now. Balance what? Balance carried down. How much is 10,000? Then you're gonna transfer this balance here. It's gonna be now balance balance brought down. How much is the balance brought down? It's gonna be 10,000. Then we are done with our SARS income tax. Please master this one. Do it over and over again. Now even this one, it's very important. And then now this is our appropriation account. Then we're going to our return income. We're going to write appropriation account here, general. Let's close off our ordinary share capital. It's gonna be 2,500,000 plus 1,280. It's gonna be 3,780,000. 3,780,000. Let's check now the difference. Minus 324. It's gonna be 3,456,000 now. This one is gonna be our balance carried down. Then it must be seen here. It's gonna be our balance brought down. How much? It's 3,456 now. And then let's finish now our appropriation account. Okay, now let's go back now to our appropriation account. Here, because of buying back, I'm going to manipulate it a bit now. Here I'm going to add bank, and then in bracket I'm gonna write buying back. Remember we spoke about the price for buying back. The shares were repurchased at 7 rand, but the average price, it was 5.40 rand, and the difference between the two is 1.60 rand now. Then here now it means that the 1.60 rand will comes from the returned income. Now what I'm going to do now, I'm gonna just write bank there, but it falls under return income. And then this one is 1.60 rand. It's gonna be 160 multiplied by the number of shares issued. It's gonna be 160 multiplied by 60,000. It's gonna be 96,000. It goes together with the return income, this one. Okay, now let's calculate now our return income balance. We're gonna balance it with the bigger side, and the bigger side obvious is the credit side. Then let's balance it now. 1,700,000 plus 950. We're gonna close it off with 2,650,000. 2,650,000. All right. Then it's gonna be 2,650,000 minus now 96 minus 560 minus 510. Then our return income will be 84,000. 1,484,000. Okay, this is our return income. Let's finish our shareholders for dividends now. Let's go and check now. Is there anything that talk about shareholders for dividends? This one, shareholders for dividends. Remember, it's declared and not paid. Then now it must be seen here now. It's gonna be dividends on ordinary share capital. How much is the amount? The amount is 420,000. It means we are still owing our shareholders. This one is declared and not paid, so it's a liability for the company. All right. I hope you are still with me. I will do now the note for the return income, as I know that most of the learners will not understand the return income, especially in the appropriation account. Let's do the note now for the return income. The note for the return income goes as follows. Balance at the beginning, net profit after tax. It's gonna be buying back here. It's gonna be buying back, and remember our buying back is gonna be 60,000 multiplied by 1,6. Then here we're gonna have dividends. Dividends is differentiated into two. The first one is our interim. We do have our interim. The second one is our final. Then our interim, we calculated our interim dividends as how much? As 140,000. This one is 140,000, and then this one is 420,000. Then we have balance at the end now, and then the balance at the beginning we're given as 950,000. Net income after tax, we're not given, but we're given net profit before tax. Net profit before tax, it was 1,700,000 multiplied by, if now listen to me carefully now, if income tax is 30%, net profit before tax it always 100%. Then how do you get now after tax? After tax it's gonna be 100 minus 70. It's gonna be 100 minus 70. No, not 100 minus 70. 100 minus 30. It's gonna be 70%. Then here I'm looking 70 all over 100. Then it's gonna be 17 multiplied by 70 all over 100. Then you're going to get 1,190,000. Then the buying back is gonna be 60 multiplied by 1,6 is gonna be 96,000. It's minus this one because it's a buying back. You're going to add the 2. Remember when we added the 2, it gives us 560,000. It's a dividends we are paying. Money is going out. Then now remember when you are doing your calculation, you must get this amount as your return income balance at the end. Let's prove it now. It's gonna be 950,000 plus 1,190,000 minus 96,000 minus 560,000, and we are getting the same amount. It means our return income is correct. Thank you for your time.